Today's theme is longevity. Pipelines last a long time. There used to be a video from the 1950s on the University of Texas website about the Transcontinental Gas Company. They built a pipeline to bring gas from Texas to New York. The video is no longer there, probably a victim of excessive wokeness in Austin, Texas. The video may have gone, but the pipeline is still there. Over the decades, it's been greatly expanded. Some parts of it have been reversed. Since the shale revolution allowed gas to be produced in Pennsylvania, it now also moves gas south to Louisiana for export to our friends and allies, helping reduce coal demand. Today it's operated at Transco, which is owned by Williams Companies. That original pipeline from the 1950s is still in use. They can last for many decades if properly maintained. Only a few years ago, the market worried about stranded assets. This applied to oil and gas reserves because the growth in cheap renewables was going to mean that some of that oil and gas would be left in the ground. No longer economic to produce. The same argument applied to certain types of midstream energy infrastructure. If we were going to be off oil and gas within a couple decades, the pipelines, storage assets, and other facilities would be abandoned before the end of their useful lives. They would also be stranded. Fewer years of service means less cash flow. A spreadsheet model that projected fees on a pipeline out 30 years could no longer be relied upon. How wrong was that? In the meantime, clean energy stocks have collapsed because solar and wind aren't cheap and consumers haven't been persuaded to pay more for electricity. This should have been where the debate began. Rising emissions might harm the climate. Reducing fossil fuel use can help. It'll make energy cost more, but it's worth it. This is the honest case, and I can understand why someone would make that argument. But Joe Biden and progressives didn't say that. They promised cheap energy from intermittent sources with high-paying union jobs. Why did anyone believe that? Today, realism is washing through all the projections based on fantasy that woke attitudes made mandatory. Investors are rethinking the useful lives of pipelines and other energy infrastructure. Energy Transfer just issued 30-year bonds. LNG export terminals like those owned by Cheniere routinely sign 20 to 30-year contracts to export chilled natural gas overseas. Wells Fargo recently upgraded some natural gas pipeline companies, including Williams and Energy Transfer. Instead of declining natural gas demand due to increasing renewables, the AI revolution is causing power demand to be revised higher. After a couple of decades of using around 4 terawatt hours a year, some parts of the US grid are preparing for 5% annual demand growth. Weather-dependent electricity won't be able to meet that need, so we'll need to use more natural gas. And in many cases, it'll mean that existing pipelines and gas power plants use more and last longer than perhaps some people thought. Because pipeline companies on average finance around half their enterprise value with debt, if enterprise value to EBITDA moves from 10 times to 11 times, that can translate into a 20% increase in the value of its equity. This is the near-term forecast of Wells Fargo for natural gas pipelines. These are long-lived assets. For a while, the market didn't give sufficient credit for that. It's changing. That's why we think the sector remains an attractive long-term investment. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.